All right. Happy, what is it? Geez, Saturday, everybody. Thank you for joining us. I see the folks starting to stream in now. All right, we're about to cross that 100 mark of everybody. Just absolutely amazing to have so many people here for education on a Saturday, here to make ourselves better. Let's get some trading tips. Let's get some stock ideas. Let's get some things that we can put in place bright and early Monday morning. I mean, that's what it's all about. At Benzinga, we started the business because we wanted to level the playing field. We saw, so much inequality between the information that was going to professionals and individual investors. And so it's so amazing for us to see so many of you out here on a Saturday helping us to share in that mission and in that vision. And all right, guys, and while we're going ahead and getting started and giving everybody a few minutes to stream in, give me the shout out as to where you're from. I right now I'm in Detroit, Michigan. Matt, where are you at?
We're in just outside of Boston and Newton, Massachusetts, waiting for the snowstorm. That's why I'm a little bit crazy here this morning, running around trying to get ready for what could be anywhere from a foot to 2 feet of snow in the next 12 hours.
Yeah, we get snow in Michigan, but I don't think that the snow that we get is anything like that Boston snow. I mean, it seems like you guys get dumped on.
Yeah, it's weird. We kind of stick out into the ocean, and I remember somebody saying one time, if a person lived in Pittsburgh, they said if we want to know what the weather is, we just call Chicago because we get their weather the next day. Here we get stuff it comes from the west, some comes from the north, comes from everywhere. So it's kind of it's in New England. Wait a second, the weather will change.
Oh, all right. And I see people. Let's see. We got Louisville, Italy, San Antonio, Indiana, Delaware, Florida. No snow. Yep, no snow in Florida. Nashville. I don't think Nashville gets snow. Maybe a little bit. We got California, Hawaii, Toronto, Phoenix, New York, Dallas, Pennsylvania, Ohio. Oh man, Ohio, Michigan. That's sort of an issue. But Florida, New Jersey, Uruguay, Arizona. I mean, wow. All right, we've got a group of people from all over. So hello, guys. I see some Miami on the second stream we got going, Seattle. So cool. All right. Well, again, the whole point of Benzinga is to make us all better traders, to make us money in the markets, and we're absolutely honored to have Matt here with us. I mean, he's one of the top educators around. He's got such a long track record in the markets, and and my favorite thing about him is he's an expert in all asset classes, right? It's not just stocks or fixed income or commodities. I mean, he runs across it all. So Matt, I'll stop blabbering it on. And why don't you go ahead and get started? Just the last thing that I'll say, guys, this is, again, the whole point of this segment, this next hour or so that we're going to spend together is for you guys. So if you have questions, if there's things that you're not understanding, go ahead and drop them in the chat, and I'll be calling the questions out. So, all right, Matt, I'll turn it over to you.
Sounds great. Thanks so much, Luke. The marketplace, just to give you a little bit of idea, if you haven't seen me or heard from me in the past, my background is actually on a trading desk. I do a lot of strategy work, and most strategists have worked, have been analysts, for individual stocks or groups, I should say, individual groups, and that's good. I mean, don't get me wrong, that's very good. But a lot of that stuff tends to be theoretical work, and they're telling you what should happen rather than what is going to happen or what will happen or what is happening right now. And as a trader, you learn very quickly that frequently the market doesn't do what it's supposed to do, and we look at things that tell us what. As traders, I had spent 25 years, and I worked at Salomon Brothers for 15 years, which was the most powerful trading desk of the 80s and 90s. And if you've read Liar's Poker, you know all about that era of trading where Salomon dominated things. And I also worked similarly on the institutional trading desk at Merrill Lynch. for almost 10 years there. So about 25 years in trading. And I spent the last more than a decade as a strategist. And what I try to do is combine all these different things. I mean, fundamentals, of course, are vitally important, whether they be macro. And I tend to be more of a macro strategist when I'm looking at an overall strategy. But there's also obviously the fundamental side of things in terms of earnings and sales and et cetera. So, but I try to combine that with the trading aspects of technical analysis and sentiment indicators and things like that, and correlations that a lot of people don't follow. I mean, it's kind of funny. One of the best calls I've made in recent years, a couple of years ago, when the market was getting hit hard in late 2018, and I was pounding the table saying the housing index is going to do a lot better. And people are like, "What are you talking about? The Fed's raising interest rates; they're tightening." And I was like, "Yeah, but the housing stocks are holding up well on a technical basis, and lumber prices are starting to rise in a significant way." That told me that those markets saw the turn in housing before anybody else did, and made a really good buy in several names in that group, and the stock just took off. And again, that was at a time where most housing analysts and most strategists were saying that interest rates are going higher, and the group was going to continue to underperform, which it had for most of that year until that time, late in the year when I turned bullish on the group. So these are the types of things we're constantly looking at, and it's kind of my saying that I always use is the market. One of the old sayings on Wall Street that's a very bad one. A lot of good ones, a lot of ones that aren't so good. One of the old sayings is the market is always right, and that's couldn't be further from the truth. The market is only always right eventually. There's many, many times where the market is dead wrong for a while, and that's how we can make money trading. I like to, as a former trader, I spend a lot of time. I also have that pile of money that I have for very long-term horizons, 5-10 years down the road. And you look for the next best thing that's really coming along. That's one of the areas. You're also looking for trends in the marketplace, whether it be in the economy and the marketplace, but you're also looking to hit those doubles and singles where stocks can move 20-30% or more over a shorter period of time, and you can really maximize your returns if you have the inclination and time to really watch the market much more closely. So that's kind of my background to let you know where I've been and what I've done and what I'm doing right now. But let's take a little bit of a look at the market as we see it today. And we're moving into the end of the year, and it's kind of interesting because the fundamentals are a little scary, because we're going into the situation where this new wave of the coronavirus is hitting. We're seeing more lockdowns. LA is completely locking down. And I see that San Francisco, I read this morning, is locking down. Kind of a stay-at-home situation. We're going to see more of that. We're not even in the mid-innings quite yet. I mean, we might be just moving into the mid-innings of this second wave or third wave, depending on how you look at it. And therefore, the economy is going to see that slowdown. So people are starting to get nervous. Geez, we got an expensive market. It's had this huge rally. Geez, I should probably take some profits. And it's funny because I think that's going to be something that people should do next year and relatively early into next year, not now. I think people should ride the wave. And the simple reason for that is the don't fight the Fed. I mean, it's an old saying, and it works well, and it works better sometimes than others. And one of the reasons why I think it's going to continue to work really well right now is that the Fed has to keep this liquidity, the pedal on the metal. They've been doing this QE program, but they've moved it up and down several times. Back in September, you could see by the way their balance sheet shifted down that they had taken the pedal off the metal for a little while. And sure enough, the stock market pulled back about 10%, 11% if you looked at the NASDAQ. So, and right now, I think just the opposite has to take place. They have to keep the pedal to the metal because the economy, because of this wave in what's going on in the with the coronavirus. If they keep away, especially if we don't get a fiscal stimulus, but even if we do, They need to make sure that we don't get a repeat, anything close to a repeat of what we saw last spring, because there's just so much debt in the system, the corporate debt out there. There's going to be defaults next year. They don't want that to turn into a massive avalanche of defaults, because it will have a serious impact on the economy. People always, for a long time, I said the Fed cares a lot about the stock market. They do, but in recent years, they care much, much more about the bond market and the credit markets. That's why they stepped in such an incredibly strong way back in March of this year, because the credit markets had completely shut down. You cannot have a financial system if the credit markets are shut down, and whether it be short-term, long-term, whatever. And that's why they stepped in. People forget, and one of the things that, again, one of the reasons why I'm bullish here on a near-term basis, people forget that last year's rally was very much Fed-induced as well. If you remember, back in September of last year, the Federal Reserve came in and they got involved. They came out and they said it wasn't a QE program, but they did a QE program, a new QE program. I called it the not QE program, because they kept claiming it was not QE. But they did it because the repo market, the repurchasing agreements, that market had shut down in September of last year. And so they flood the system with liquidity, and they didn't just do it for a couple of days. They had to do it for several months to make sure that market calmed down, because you need that overnight repurchase agreements, or an overnight agreements that keep that, the gears of the financial system running. And they kept that liquidity going behind the scenes much more quietly than they had in the past. And that pushed the market into the end of the year, even though it was expensive, even though people were worried about a credit market bubble and things like that, corporate bond bubble. It kept rallying because liquidity was there. Finally, when that situation calmed down, they took the pedal off the metal. The coronavirus, hit us with a double whammy, and the whole thing, kind of fell apart until they stepped back on the accelerator. And again, remember, the coronavirus, we knew about it. We didn't know about it this time last year. We knew very little about it. We knew pretty well about it in January, and yet the market kept rallying. Why? Because the Fed was still providing lots of liquidity. Okay, I kind of rambled on there for a while, but that's one of the main reasons. Don't fight the Fed. They want to be, in my opinion, will have a rocky points. I mean, we've had a 12% rally in just 5 weeks, so I don't think the rally into the end of the year will be quite as strong as it has been more recently. My target on the S&P is 3,800. Probably going to go a little bit higher than that now since it's run so far. But I don't, 4,000 is going to be a little bit tougher to get. But again, this is not going to end with December 31st, because the cold weather is still going to be here. This wave of the virus is still going to be here. So I think the Fed liquidity will still be here. And so therefore it will dip into early next year as well. But then investors are going to have to be careful. Now, why do I think they're going to have to be careful? And the reason for that is that, well, why wouldn't the Fed, people keep saying, oh, the Fed, they've told us they're going to keep rates ultra low. They're going to keep liquidity flowing. That's true. So in other words, the liquidity that I'm talking about is not going to disappear completely. But when it becomes less plentiful, just like it did in September, the market creates headwinds for the market. And why? So why would the Fed feel the need to do that? Why don't they just keep the liquidity spigots open, wide open? And the reason they don't want to do that is that right now we got a market trading at 22 times earnings, and that's very expensive. No, it's not as expensive as it was in late 1999, but we're never going to get a market that's expensive again, not in our lifetime anyway. So don't, just because it's not, historically expensive, at all-time highs in terms of being expensive, doesn't mean it can't and won't pull back. It doesn't mean it's not expensive. It is expensive. 22 times earnings is very expensive. And the Fed doesn't want to create the kind of bubble that will take it to, up into the high 20s or low 30s in terms of valuations, because then if the bubble bursts at that point, they wouldn't be able to control it. We have so much debt in the system, so much more than we had when the last two bubbles burst, that if we have a huge bubble this time around, it will be something they won't be able to control probably at all, and certainly not easily. So they want to avoid that, in my opinion. I think they've said that, if you read between the lines of what they've been saying for several months now. So even though they'll provide liquidity, I think it'll be less so. And finally, I don't want to get too involved in this, but the other big reason is that we talk about fiscal. We are going to get some fiscal stimulus. That's going to come from this relief package that I think will happen before the end of this year. the one they're talking about right now. But President Biden is also talking about a lot more, and I do believe he's going to get that at some point, and they will announce it next year. However, most presidents, Trump didn't do it, and he didn't get reelected. Most presidents back end load. They make this big announcement, and it all sounds great, but they back end load everything so that it'll be kicking in and helping the economy in the third and fourth year of their term. And when they come up for reelection, they get reelected. I mean, nobody cares about the first year. The guys who did care about their first years were Jimmy Carter, the first George H.W. Bush, and Donald Trump. All of them did really well, and their economies and the markets did really well the first year, and they didn't get reelected because they couldn't keep the momentum going. The guys who have been successful and reelected were Reagan, Clinton, the second Bush, and Obama. All of which, I mean, Reagan and Clinton both had recessions in the first year of their nobody's going to care about their first year when they come up for re-election as long as things are doing better. So in other words, we have a presidential election cycle, and it involves a bad first year and a good third and fourth years. It's not a coincidence. They set it up that way. At least the smart ones do. And I think Biden will do the same thing. He's been around long enough to know that's what he'll need to do. So we're not going to have as much liquidity next year. And when the market's as expensive as it is, it's going to cause some hiccups and some pullbacks. So even though I'm bullish now, in my market letter, the one thing I'm pushing is like ride the wave, continue to ride the wave. But I think we're going to have some big hiccups next year. And overall, the year is going to be a much more difficult one than most people think, because we've already, yes, the economy is going to get better, but usually the economy, as the economy improves, the stock market, it moves in advance of the economy, but it doesn't go to new highs. It's usually still well below its previous highs. But because of all the liquidity and stimulus that has been provided this year, even as the market is going through a second wave on the downside and the economy is still not doing well, the stock market is at big all-time highs. So in other words, usually the stock market really flies and plays catch up to the economy. With the stock market already up, it's going to be the economy that's going to have to catch up to the stock market. I've kind of rambled on there a little bit, but let's just talk about the way I look at things in terms of how I look at stocks and what I try to do. One of my best things, and one of the things I try to do best, is get stocks and groups at key turning points. That's when you can really make the best money, because when things get washed out, they throw the baby out with the bathwater. They become very, very inexpensive, and that's how Warren Buffett became a billionaire. I mean, most billionaires in the world are started their own companies. Warren Buffett is just an investor, and he did not buy things that were expensive, hoping they'd get more expensive. He bought things when they were dirt cheap. And nobody else wanted them. He got unbelievable prices, and it's what really maximizes your benefits. However, there's also other areas, especially through my trading, my knowledge from trading over the years, is that I want to hit lots of singles and doubles. We want to get those things where you can make on a trading basis over a month, even over a couple of weeks, you can make 10%, you can make 20%. Take your profits, move on to the next one. In some cases, you make a lot more. I mean, in my market letter, one of the just over 2 months ago. So it was, I guess you say 9 weeks ago. I picked one of my picks was Invesco. And the stock is up over 50%. Okay, in 2 months. I picked it at the very beginning, October 4th. And so it's just barely over 2 months now. I guess we have 2 months in a day. And the stock is up 50%. So these are the types of things. So that one turned into from a single into really a home run. I mean, the big home runs, the grand slams, are the ones that can go up a lot, go up several 100%, double, triple your money. And on a long-term basis, we're always looking for the next Microsoft, Tesla, et cetera, where you can get 10 times your money or 20 times your money. But we're also looking to get those ones where we can continually hit those doubles and singles and still maximize your number. And the other thing too, of course, when you're trading, as one of my rules of thumb, especially on the shorter term trades, you minimize your losses. You never take a loss more than 10%. And I like to keep it, not much more than 5%. Walk away. You are going to have some that don't work out well. And the key is not getting the big blowups, not having the ones where people lose 50%. They think they got the next best thing. You may have it, but once it's down 10%, get out and find another time when you can get into the stock and buy it and really make those moves. So that's just one example. I've had several others. Boeing is up. I just saw the writing on the wall in terms of the worst was out. They'd finally gotten it was shocking to me that we didn't get a better move in Boeing after the FAA announced that they announced that they were going to, okay, there's 737 MAX plane. The stock moved up a little bit, not hardly at all. I jumped all over that. This is really good news. I mean, the Boeing is not going out of business. There's only one other airline maker in the world. Jumped all over that. It's up over 20% in 3 weeks. Here's a stock that's been gotten clobbered many times. So another one we have is I think was my first pick. Now this is about 3 months old, but it's Glencore, GLNCY. It's actually a Swiss company, but you can buy through ADRs. You can buy it you don't have to buy Swiss francs and all that stuff. You can just buy it or the euro, but you can just buy it in the US. And there's a stock that's up over 40%. Here's one that went down 8%, but it was in my long-term play, both my long-term play and my short-term play. And I was like thinking, oh, geez, if it gets down 10%, I'm going to get out of it in my short term. I'll stick with my long term. Well, it's right. When it's up over 42% as we speak, not since its lows, 42% since I picked it. So it's actually up about 50% from its lows. So these are the types of things that I'm constantly trying to pick from my subscribers so that people can really, who have the time to, not just want to invest on a very long-term basis, but can also have the time and inclination to trade. And in this day and age with no commissions, and you get information to you so much quicker. I mean, 25 years ago, individual investor was getting news days after the professional trader. Now we have the process where we can get it immediately and can take advantage of it to the same way that we've heard about all these hedge funds making gazillions of dollars over the years. I'll just give you one other example.
Yeah, can I pop in with a really
quick? Sure, I'm sorry. I get worked up when I start talking. So
that's good. But the question essentially is, how do you use stop losses? How do you think about stop losses? That sort of thing.
Very, very important. The stop, and that's how we want to maximize our thing. When I go in to pick a stock, I have a target price. Now, if we get even better news as we go along, we can raise that target price. But no matter what, as I mentioned, we want to minimize the losses. You do not want to take a big loss. If it's down, even much more than 5% on any kind of a trade, on a trading vehicle, you want to get out of the stock. The same is true on the way up. It's like, okay, now I have a target. Once it gets to that target, what do I do? And in many cases, I'll say, what's the story? What has anything changed? No, nothing's changed. This thing's getting overbought. It's getting overvalued. Okay, take my profits and move on. But if something has changed and of course, if the stock goes up and gets halfway to my target and something changes and it's a negative change, I want to get out. Let's just get out, take our profits and move on. But if we get better news, okay, well, I'm going to raise my target. I'm still going to take some profits, though. You always want to take, the old saying, nobody ever lost money taking profits. Well, it's true. You've doubled your money. Well, if you've doubled your money, why wouldn't you sell half your thing? Because now everything you have is gravy. Because if you've doubled your money, that means if you put $5,000 into something and now it's worth $10,000, you take $5,000 out, you can't lose. There's no way. If it goes to zero, you can't lose. But of course, nobody wants it to go to zero and let it go to zero. So we move our stop levels. We have a trailing stop. In other words, as the stock goes up, we want to put as the stock goes up, you want to put the stop out limit and have it go up. So it forces you to take profits. You want to be able to do that, even though you believe the biggest problem is people get stubborn or they just think it's worked before, so it's going to continue to work. It's the biggest mistake. It's human nature to do that. We always think, if we have a team, the New England Patriots fans are like, what happened? The Patriots always win. Well, now they don't so much. And it's not just in the stock market. We've got to use those stop losses. Again, number one, to protect stop levels. And they call it a stop loss order because they're usually used to protect your losses and to keep them to a minimum. But they also protect your gains on the way up. You just move those things up. Again, it can change. If you have a really good profit in something over time, let's say it has doubled. And it's like, it's overbought. It's probably going to drop 10 or 15%, even though it's up 50%. Or I'm sorry, it's up 100%. So if it goes down or 10 or 15%, it may just be a technical move to work off its overbought condition. You don't want to get stopped out, so you can kind of gauge your stop loss orders and move them around a little bit. But you always want to have them at some point because it will help you. Believe me. You want to, when it leaves, oh, I've doubled my money, it's never going to go down. Well, all stocks go down. People, I just looking at charts of Tesla here in the last, looking at them this morning again. I mean, they've had two dozen corrections of 20 to 60% in the last 10 years. So those who just held on to it have done very, very well. Those who have been able to trade around it have done very, very well. But those who just, who thought that it can never go down have gotten burned pretty badly.
Awesome. Thank you, sir. I appreciate it. Very well answered.
Good. So just to move on a little bit about what I'm thinking right now, and I'd like to talk about the two groups that are really, playing three things. Number one, this whole thing with the rotation. Everybody's talking about rotation in the marketplace, and it's something I agree people should be doing. Moving out of some of these big cap tech names. But don't get, I mean, these are good companies. This is not 1999 all over again, where Tesla, not Tesla, well, Tesla too, but the FANGs, Facebook, Amazon, Apple, Netflix, and Google, they're not going to go out of business. I mean, they're great companies, but they are very expensive. And even though we're going through this second wave, there's probably not going to be a third wave, because the next time the weather gets cold, next fall, we'll have enough vaccines to keep the situation for everybody staying at home once again. So people are going to, these institutional guys are going to sit back and say, do I really want to own these great companies at that? I don't mind paying, a higher valuation, but do I want to pay that much? Because, if there were no vaccines on the horizon, they'd be like, sure, I'll continue to pay that because the stay-at-home play is going to work for 2 more years. It's not. It's going to work for a couple more months, and we have to look beyond that. But again, they're great companies, so you don't want to be, anybody think Amazon's going to go out of business anytime soon? Of course not. Hold on to some of your position, cut back some of it, and rotate into the value names that I'm about to talk about. However, don't be afraid to rotate within the tech sector. Just because you're moving out of some of those big cap names doesn't mean tech is not dead. This is, again, not 1999, 2000 again. Look at the chip stocks. They are exploding to the upside. They've got all sorts of upside potential there. Again, they're getting a little overbought on a near-term basis, but the Micron Technology, Advanced Micro Devices, Texas Instruments, Taiwan Semiconductor, all these names have had great moves here, and many of them have been in the picks that I've made in the stock and the Benzinga Tier 3 Stock Pickers call. We've also have things like Seagate, another one, Intuit. Again, it's not just chip stocks, and it's not just the FANG stocks, the big caps. Technology, we still want to be rotating some of our money within tech. Okay, but what about what other values? There's some real good value plays out there, and people have been looking at. But people are going, well, geez, the economy is going to do really well next year. I'm going to go into the industrials. Well, the industrials have done fine. They've done really well. They're actually pretty expensive. I know people try to talk about them because they're not as expensive as some of the growthy areas, but they're still expensive and they're still overbought on a technical basis. However, the groups like the banks and the energy stocks are not. They are still very, very inexpensive, and they're still very, very underowned. And I think they've got some more upside. And I'll tell you, the other thing we have to look at too, again, as a trader, I know how these institutions how to work. I cover the trading desk of big hedge funds, big mutual funds, BlackRock, Fidelity, you name it, JP Morgan Asset Management. I've covered these guys, and I know what they have to do at the end of the year. They all, whether it be traders at those companies or the portfolio managers, they all say they're long-term oriented, and they are in many cases. But they all become short-term oriented at the end of the year because they care about their bonus and they care about their job. If they're behind the market, if they're behind their bogey, they have to play catch up. And what's the best way to play catch up? Getting into a group that's been lagging, that nobody owns, and you get into it early, and you can play catch up. It's very hard to play catch up at the end of the year, but sometimes it's easier than other times. This is one of those years because the bank stocks and especially the inner stocks are very under-owned. And the same thing will happen as we move early into next year. And on the same reasoning, when you start a new year, you and I mean, we don't care. I mean, we're not going to fire ourselves. If we make a bad decision on a stock, it's like, or on a group, okay, we made the bad decision. It's, want to do fire. I can't fire myself. It's my money, so I'll change and do some things. However, institutional players, portfolio managers, they get fired. They can say, okay, I'm in a mutual fund. I'm going to pull it out of that fund and put it into another fund or a hedge fund. I'm going to take my money from you and give it to another hedge fund or move it into a different area of the marketplace. For these guys, therefore, not only do they want to play catch up at the end of the year, or they have to stay with a group that's moving, even if they're outperforming. They don't feel they need to play catch up. Fine. They've had a great year. They've got a good bonus coming. They want to make sure they keep that great bonus by beating the market by even more. But also at the beginning of the year, these institutional guys are like, I don't want to fall behind early. So even if I don't believe in the energy stocks, I don't believe that these things are going to go a lot higher, they have to buy them and because they're very underweighted. And if they fall behind, there's nothing worse than sitting there in the middle of February or the end of February saying, oh my gosh, I'm behind the market. I'm going to spend the rest of the year clawing back, trying to make up the losses I've had so I can keep my job or get a bonus or whatever. And you can play those games. You can use them. They've been using us for years. As they say, moving the smart money into dumb money. Well, let's flip the tables on them, and that's going to work really well. I think that will work here on these two groups. Okay, but what about the fundamentals? Well, the fundamental picture, number one, is we're looking at interest rates, and longer-term interest rates have been rising. And right now, we're getting up towards 1%. And if we break above 1% on the 10-year yield, and we could pull up a chart here, but we'll just talk about that one-year yield. That is going to, 1% on the 10-year yield. And people say 1% is a round number. Well, on technical analysis, round numbers rarely really mean that much. They sound good on TV. But in this case, this round number is very important. And the reason for that is the trend line going back to 2018, so it's 2-year trend line. It's breaking above that. If you get above 1%, it will be above that trend line, and it will be above. It will also have made a higher high above the June highs. And one thing in technical analysis that we really want to always talk about: higher highs and higher and higher lows, or lower highs and lower lows. In this case, interest rates made a nice higher low this fall, and now is breaking out to a higher high. So you're breaking out, and then on top of that, we had a big sideways move in interest rates over the summer. So they were going like this, down for years. Then it leveled off, performed a very nice base. Now it's starting to break out. And if it breaks that 1% level, it will, again, break those two key, make a higher high, that key resistance level there, plus break above its trend line going all the way back to 2018. That's the kind of thing that tells you, not only is it, oh, okay, nice little breakout. No, this will confirm a change in the trend for long-term interest rates. And we hear all these people say, don't worry about it. The Fed's not going to let them go higher than 1.5%. That's fine, okay? And so I'm not going to say that they're going to do what they don't control long-term rates. They control short-term rates, but they can still do things to impact the market, like add more QE and keep interest rates from running away. However, they cannot control the long-term rates on things. And even if they keep the market from imploding, which I think they would, they still are going to let rates go a little bit higher. And if that happens, the bank stocks are going to take off just like they have. Now, they've had this huge rally so far from its lows, but they're still inexpensive. That's why you sit there and say, well, the industrials had a great run. Some of these airlines have had a great run. Are the airlines cheap? I mean, there's still lots of questions of whether people are going to come back to flying. You might be able to make a lot of money, and I think there's some opportunities. Royal Caribbean is breaking out right now. That could be a good name. It's one of the names I've mentioned in my level 3 stock pickers phone call I make 3 times a week. But and that's up nicely, and we've had a real nice gain in that one. We have a real tight stop in that one because it's a lot more risk involved. But the thing with the bank stocks, over the last 10 years, they have recapitalized themselves very, very nicely. So the downside risk is nowhere near as big as it is in some of these other names that have gotten clobbered. And it hasn't, and even though they've rallied strongly, they sold off for so much more and underperformed for 3 years that they have a lot more upside potential. And I won't go into the yield curve, but that's all. It's also now at its steepest level since 2018. And the spread between 2 years and 10 years is now 80 basis points. That's not very much, but again, it's the most in 3 years. So it helps this group. As for the energy stocks, the same thing. The energy stocks, even though they've had this huge move, they're still nowhere near their highs. They're still below their highs from February, much less all-time highs. But more importantly, they're trading at levels. The last time they were trading at these levels, the oil was at $32. Now it wasn't $46. Okay, nobody believes this. It's less than 5% of the S&P 500. All these institutions are wildly underowned, and none of them believe it. You listen to CNBC or Bloomberg TV or Fox News, Fox Business News. Every pundit comes on and says, no, this can't hold. This can't hold. Oil prices aren't going to stay up. They don't have to rally a lot more. Like I said, these stocks are trading like that. The oil price is going to go back into the low 30s. OPEC just got another agreement this past week. I think that's going to help these energy stocks continue to rally into the end of the year. And again, it will force some of these institutions have no choice but to go in and buy these names late this year and early next year. So that rotation is kind of what I'm looking at. And that's kind of my big picture of view for between now and early next year.
And Matt, can I hit you with the question that I saw?
Sure, please.
I think this one's interesting. So basically, the question is, once you start to recognize some of these sector or industry trends, how do you identify the individual names that are interesting within those sectors?
Well, I use a couple of different things. First of all, I use a lot of technical analysis. And one thing I've heard me say before, but this is one thing that's very important. There's some guys out there, very, very smart, fundamental money managers who've done very, very well and have great records. And they say, I don't look at the technical analysis. It's all just a bunch of mumbo jumbo. It's just a bunch of lines drawn on a page. It's not. It is fundamentally based. And I'll look very quickly. I don't want to take too much time, but just to think about it. If you have a company and you've been having a tough time for several years, okay, and all of a sudden things start to get better. Well, you're the CEO of that company. It's like, gee, I've laid off all those people. I've got to hire some of them back. I've closed one of my factories. I've got to reopen that factory. I've closed a bunch of stores. I got to reopen some stores. Well, that takes time. Okay, but the guys at the institutional companies, they're not gonna wait. They're gonna see this because they have an army of analysts to tell them, hey, things are turning around for this company. Their earnings are not going to be better in 2 weeks from now, but they're hiring more people. They're opening their factories. Their sales are way up, and in 9 months from now, their earnings are going to turn up. And the portfolio manager at the institution is going to say, or the hedge fund, well, I'm not going to wait for 9 months. I'm going to buy it right now. And that's what technical analysis does. They start to buy it, and we can see that. And that's why I always say that stocks or the overall market move in both directions 6 months ahead of the fundamentals. So that's why we look at that. So that's one of the things I look for stocks that maybe are breaking out or forming nice bases. So that's number one. Number two, I look at correlations. For instance, John Deere and Cat Tractor, they basically do almost exactly the same thing. I mean, there's certain differences, but for the most part, one has more exposure in China than the other, but they're both very, very similar. However, for whatever reason, it's crazy, but every year and a half, 18 months, they should be trading in tandem all the time, and they do. But there's a divergence develops, and sometimes this cat is ahead, sometimes it's Deere. You never know. When it happens, there are certain signals that I look at my indicators that tells you, okay, that's enough. It's going to close back up, and it always does. So whatever that lagging stock is, you buy it, and it kills it. I mean, one time it was really because Cat Tractor becomes so overbought. Its relative strength index, its RSI on its chart, became so overbought, is above 9. It was at 93. I'd never seen something at 93. Since then, Bitcoin got to 100 once. But the point is, it was like John Deere has to play, even if cat goes down a lot, John Deere's got to play catch up. And so those types of things I also look at through the technical analysis. But also, again, the correlations aren't just from stock to stock. As I mentioned earlier, we have the correlation between lumber prices and housing stocks. We look at, and you have to be careful though, because some of those correlations are not good. Everybody says, oh, oil prices. When oil prices go up, that's bad for airlines because it costs, their costs go up. Well, history shows that, first of all, most of them hedge their oil positions, so it's not an issue. And it's usually, if oil prices are going up, it's because the economy is doing better. And if the economy is doing better, airlines do better. More people fly, both business and other. So, I mean, obviously right now with the pandemic, it's a little bit different. But the point is, you got to know your correlations. I mean, one of the ones I follow that almost nobody does is I look at a plastics index out of Taiwan to tell me what's going to happen in the semiconductor stocks, because they have all those tiny little chips have a certain amount of plastic in it. And when it's going up, that's usually bullish for the chip stocks. So those are the types of things I look at. One of the things that I just wanted to talk about as we we move into the well, how much time do we have? Okay, good. Into the end of this year is remember the thing that we have to. So then I just want to go on one other thing before I move to that subject is just talk about technical analysis. And one of the things that is important to watch is this relative strength index. Is one that I've used for a long time, and you can use both on a monthly and a weekly basis. I'm sorry, on a daily, monthly, and weekly basis. Monthly is a little bit less helpful for traders. I use that more of as a confirmation thing. But really, if you look at the daily and the weeklies, especially the weeklies, we have because, and you have to understand, again, the relative strength index is what it is. It just measures how well the stock is doing on a short-term basis, when how many people are, how a stock reacts when it's trading on upticks versus downticks, or when it's the momentum it has on the upside versus the downside, because obviously a stock during a day, it has all sorts of moves through all day long, all week long, and it kind of measures that. And when things get too extreme, when you look at this RSI, if it's moving up, it gets to a level where you get very, very, it's great. Follow the trend. The trend is your friend. That looks great. But when it gets extreme, and in the RSI gets above 70, that's kind of the key level on the sell side. It's like, oh, it's getting too high, getting it too extreme. It's probably got to at least pull back a little bit, if not come down a lot. On the lower side, you see the RSI chart at 30. It gets below 30. That's usually a buy signal. But it's very important to know each stock and each group when you play that game, because it changes from time to time. For instance, and I think everybody's talking about, I want to spend a little time here on Tesla and on Bitcoin, because these are obviously, these are high flyers. I think both have further to go over the near term. And one of the things we see on Tesla is its RSI chart, its weekly RSI chart is getting expensive. It's gotten up to 75. Okay. That's expensive. For most stocks, I'd be saying, oh boy, you don't necessarily have to, you don't want to short it. Well, you don't want to short Tesla. There's very few times you want to be shorting Tesla anyway. But take some profits, or if you like it and don't want to take profits, but avoid buying more. Most stocks, you get to 75. That's a pretty good indicator. But if you look at, especially on the daily charts can get that high frequently, but 75 on a weekly is pretty extreme. Well, it's not for Tesla. In the last 2 years, it's gotten above, well above 80 4 different times before it topped out. Right now, so that means it's a 75, tells me the stock is probably going to go higher, and probably at least 650 is kind of my thinking on a near-term basis, and probably 700 before it tops out. But I think we'll look at the weekly RSI as it gets above 650 and towards 700, and I'll kind of make a call there. But and we'll see if it doesn't get extreme, we can still continue to ride the wave. But the thing about the stock is we do have to be careful, because I think next year you're going to get another big correction of 30%, and people will want to take profits, or at least avoid buying more. And if you want to get short, that's very, very dicey with this name, but that's something I follow very closely. Now, the thing is, I just did a chart, looking at a chart of it today. the stock is, it's like I said, it's seen 24 corrections, deep corrections over the last 10 years. It saw 4 of them, 4 or 5 of them just in the last year. And just this past year, I'm sorry, the past 2 years, I'm sorry. And one of those, of course, was a 60% pullback when the whole market got hit hard last spring. But my point is, you want to be very, very careful as we move into early next year, because Tesla is also a risk-on trade. And when the liquidity that I talked about earlier, as that starts to pull back, it's not going to dry up, it's not going to be shut down, but it becomes less plentiful, something that's reliant on ever more increasing liquidity. No matter how good the fundamentals are, no matter how good the stock may be going to $10,000 in 2 years, maybe that's fine, but it will continue. A stock that's had 24 deep corrections is not going to suddenly stop having deep corrections. So you need to be careful about that. The same thing is with Bitcoin. Bitcoin right now, an unbelievable amount of momentum. I have been saying for a little while now that it would get to 20,000, between 20 and 22,000 before it topped out. Now I'm thinking it could even go higher than that. We'll have to see. My point is, excuse me, pardon me. This is another one that one of the things that the bulls, I think, need to be very, very careful on, is all these bulls are talking about the fundamental reasons why you should hold and own Bitcoin. 3 years ago, I thought Bitcoin was a joke. I called the top at 18,000, fell out of bed. But in the last year or so, I've become much more bullish on the long-term prospects. And I think this thing could go way higher. I mean, 50,000 is very doable in the next year or two. And I think long-term, there are people putting $500,000 targets on it. You don't want to get too far ahead of ourselves, but I am very, very bullish. But I also realize that this thing has huge corrections along the way, and you've got to be able to ride them out. And if you're nimble, you can profit very nicely from it. Whether you be, again, shorting is a very sketchy thing to do in this thing, but you can take some profits and sit on them for a while, because it doesn't take long, and suddenly the thing drops 30%. You can put the money back in and trade around that position. It's something that people can do. You want to have that hardcore position if you like it on a long-term basis, like I have. I don't have this right now. I've now taken. I'm a little cautious on it now, but I do think people can hold on for a while. But my what I'm saying, telling investors right now, is saying it can ride a little bit longer, hold on to the position, a core position, and use another part of that money to trade around it, and you can make some real good real money. But again, this is people getting back to my point on Bitcoin. This part of this move has nothing to do with all these things that the big bulls talk about. Part of it, a good part of it, has to do with that people have to put their liquidity somewhere. Remember, when the market exploded to the upside, when this massive amounts of liquidity came in the market in March, everything went up because everything was washed out and down. But then when the market became a little bit more fairly valued, now it's very overvalued, but became very fairly valued, people started going, I'm just going to put my stuff into a small number of things. I'm just going to put it into what's working. And we have all these, professional traders with the algorithmic trading, these hedge funds, and they just, look what happened to those FANG stocks. They just took off during the summer. Everything rallied big from March until May, in early June. But only a few things continued to rally in a major way this summer. The rest of the market kind of moved along. What was it? It was the FANG stocks. Well, what happened in December? They fell out of bed. They fell out of favor. Now we've had another surge of liquidity. The market's going back up. Instead of going back into those FANG stocks, the people are saying, oh my gosh, stay at home is not going to work anymore. I want to go into something else. What have they gone into? Bitcoin has been one of those things. In other words, they're just chasing momentum. This will last a while longer. Again, I think this liquidity is going to be with us for a while. And again, no matter what you think on a long-term basis, I have some people who are just beating the doors down, tell me I'm crazy. I sit there and say, this thing's going to go down 30% next year. It is. And they tell me I'm out of my mind. And I go, maybe it might not happen, but it's happened every year, several times since 2013. Every year. Why will next year be any different? It's a speculative play. I don't care what the long-term prospects would be. Again, I'm a bull. I'm very bullish long-term. But be careful on that, especially as we move into the new year. We get much past January, I'm going to be one that's going to be saying, walk away. When the liquidity becomes less plentiful, this asset class is going to come down and will provide a great opportunity later in the year to buy it back again. I don't know how we're doing on time, Luke. But,
we're getting towards the end, but I saw a couple questions pop up about options, and
yes.
and they're essentially asking, do you use options? If so, how do you use them? Sorry, any insight there is helpful.
Yes, options are such a great way to take advantage of situations. I mean, one of the things in my stock pickers, again, I do this the Benzinga Stock Pickers newsletter, and one is level 1, tier 1 is where we have just kind of the long-term 3, 5, 10-year horizons, and some of those are a little bit I say some of them are conservative because we get dividends and things like that. Some of them are the plays that we really think are going to change the world, and then the next one is a level 2, tier 2, where we do the kind of the swing trades, and again, which I mentioned earlier, one of the things that I've been very good at over the years, done in gold, individual stocks. I mean, Tesla, when it was at 38, was actually at 190, but that was pre-split. At 38, I was pounding the tables, buy it, buy it, buy it, buy it. 38, it went to 500. I rode it till 500. It got to 500. I said, sell the stock, and it dropped 36% almost immediately. So it's worked out really well. But options, when you get those situations, I made a call on Wells Fargo. Not a big fan of Wells Fargo as a bank overall, but the stock had been completely washed out. The sentiment become really bad. There was nothing but bad news. And so I said, I put it again in my tier 3, which is a call that we make 3 times a week for 20 minutes to a half hour. And I talked about a number of names on a daily. I talk about all the picks I've made on tier 1 and tier 2, and I add some more names. And one of those was Wells Fargo, which the stock is up about 25% since then. But the options that and again, I noticed that there was somebody out there that made a huge play in the options market. It was probably an institution. They bet almost $1 million on a play. I was like, this guy knows something. The people in the option, the real smart people, don't bet huge in an option unless they think they know something. Sometimes they don't know it, but they think they do. But either way, it's amazing how often it works. 700% return in 2 weeks. Okay. So options can be, you make 7 times your money. Again, I'm not saying that happens every day. I mean, I'd love to make those kind of picks, but yes, is the answer to the question. It also is I think, a much better way to play the downside of things. Getting short things is a dicey play. Plus you absolutely have to have a margin account if you want to short something. And of course your losses can be limitless. I mean, if you buy a stock at $10, the most you can lose is $10 per share because it can't go lower than 0. Although oil somehow went lower than 0 this year, but for the rest of us, it can't go lower than 0. If you short something, it can go to infinity and you can lose an infinitesimal amount of money. But if you buy an option, you know exactly what you can lose. And of course, you can buy and sell the option. And that's what a lot of people do especially in puts. They'll buy a put to protect themselves and they just let it run out. It's like, well, if you realize it's not going to work, at least sell it. Okay, you lost half your money, but don't lose all your money. But the point is, you can hedge or make a bet with a much lower amount of money. And a lot of people, it's funny, in Barron's today, people were talking, I can't afford to, it's too expensive to buy a share of Google, a share of Tesla, a share of, but you can buy the options at a much lower price. But again, on the short side, instead of getting short, a good idea is not just on a hedge. If you want to make a bet that something's going to go down, and believe me, I'm going to be making a lot of bets like that at some point, probably in the second half of the first quarter, February, March timeframe. I think we're going to be in for a rough time in the marketplace, and puts are going to be a great way to take advantage of that because it also allows you to hold on to your core positions that you really like for a long-term basis. You ride it out with some push and still participate on the way down. And the one last thing I just mentioned on this, Luke, is that so many people, and when the individual people come in and become traders, well, it worked really, really well in 1927 and 1928. Well, in 1929, these people got killed. All right. That same thing happened in 1997, 1998, 1999. Individual traders, they always played because all they did was go long. All they did was buy stocks and let them ride up. They didn't know that or didn't understand in many cases how to short, and that's difficult to do. But now that the options market is so much more liquid and so much more, the options aren't free like trading stocks are, but they're very, very cheap, and they're a great way to get exposure not just to hedge yourself, but to make some downside bets. And the point is, though there's going to be, I think, this time around, whenever this kind of, this market eventually will have another bear market, we always do. People who I think will be a lot more sophisticated, who are a lot more sophisticated, and they don't have to be ultra sophisticated, just be willing to recognize those things and make money on the downside, make money in both directions, and not get clobbered like they did in 1929 and 1930 and in 2000 and 2001 and in 2008. Play it from both sides, and the options market is a much easier way to do that than shorting stocks. There's also, though, the ETFs, of course, where you have some inverse ETFs and even 2 and 3 times ETFs that work out very well. But be very, very careful on those 2 times and 3 times ETFs, because if the market goes flat, they don't stay flat. They go down in value because they're leveraged. And so they're very much trading vehicles. They're not long-term vehicles. If you want to buy the SPY because you think it's going up, or if you want to buy the SH, which is the inverse S&P, that's fine. But the double and triple ones, be very careful. Those are trading vehicles. You want to get in and out of them in days, certainly within a week or 2.
Awesome. All right. And as we're starting to wind down on our time, I wouldn't be doing my job if I didn't talk about the newsletter. And I've got my notepad here with me because we do have some special pricing here today. I jotted it down. But essentially, what you all can go ahead and do if you want to continue the educational journey with Matt, if you like the way that he thinks about the world, both the macro environment and then down to the individual stock level. We do have, you can get 2 of his ideas sent to your inbox every single month for just $67 a year. That's a special pricing for today. It's normally $200, I believe, but $67 a year today. That's $5.58. And the whole point is not as much just to feed you guys the stock ideas, but also to give the education around it, right? It's not like you just get tickers, but you also get some of the thinking that Matt provides. So you can start to do this for yourself and start to analyze markets for yourself. And unlike markets, this investment is totally risk-free because there is a 2-week money-back guarantee. So if you're saying today, hey, I like Matt, and then a week goes by, you're like, I don't really like Matt anymore. Just email us. There is that 2-week money-back guarantee. You just shoot us a quick email, and we'll refund it over to you. So that's if you want to get 2 ideas a month. We do have another option. So after you go through that first checkout page, you can actually add 4 more trades a month. So you're getting communications from Matt 6 times every single month with the stock pick, with the macro analysis. We'll be talking about Bitcoin, commodities, etc. What he likes and thinks is interesting at the time. And that one is just $200 a year. So to get 6 picks a month, it's only $22 a month. Again, that's some special pricing. It's funny. I had to write it down in my notebook before we got started. I'm going to go ahead and drop the link into the chat here. So that way you guys can go ahead and check that out. There is a special coupon code today. It's Stock Picks 30. You do have to use that coupon code at checkout in order to take advantage of that. And sorry guys for interrupting the flow. But again, I wouldn't be doing my job if I didn't talk about, how you can be a part of this conversation and get this education on an ongoing basis. I'll grab another question out of the chat sort of while we're winding down. If anybody has any last minute questions, drop them in. We'll try to get to them. But Matt, can you talk about bear market in general? I saw a few questions come into the private chat asking about whether you see a bear market on the horizon, etc.
Well, I mean, the risks are certainly there, and the bear markets have not been completely outlawed because people think, well, don't worry, the Fed will never let that happen again. One of the biggest problems that human nature runs into and has had it over, as I say, over centuries, over millenniums, that people sometimes think they can defy the laws of nature. What goes up must come down, and everything in the world happens in cycles. It's not just the markets. And to think that we will never have another bear market is crazy. I mean, we've had 2 horrendous bear markets in our lifetime. Usually you only get 1 in a lifetime, and we've had 2 already. And I'm not saying we're going to get another 50% where the market goes down 50%, but corrections are normal and healthy. so are bear markets. The odds that we will get one next year is I think a lot higher than most people think. And I say next year to 18 months. Again, we have a couple of things going on with valuations. When valuations get too high, people just get complacent. We have a certain amount of complacency. The other thing is that interest rates. How much lower can they go? If we do get a bounce of inflation, which will be positive over the longer term, will have an impact on asset prices because valuations will no longer be acceptable at these high levels, even in the high teens. I mean, when I got into the business, interest rates were really high. I mean, 17 times earnings was considered incredibly expensive. Now people say that's cheap. Well,
I was about to say, like, yeah, I'm buying value stocks at 17 times earnings.
Yeah. So the one thing though is I think the Fed will do the Fed and other global central banks will do things to make sure that we avoid the kind of catastrophe we saw during the what do you call it, the financial crisis of 10 years ago or 12 years ago. But bear markets, and I'll be honest with you, I hope we get one next year. I know that sounds crazy, but that will be normal and healthy. Because if the Dow keeps going, we go to 40,000 and we get to 28, 29 times earnings. We have a year ago this time, everybody was talking about, on Wall Street, was talking about a big bubble in the corporate bond market. Well, guess what? Corporations have added massive levels of debt to their balance sheets. So if it was a bubble a year ago, it's way bigger now. We need to let some air out of that bubble. We're going to get some defaults next year. That's going to scare a few people, and that's okay. That's normal and healthy. And that's why I say is that if you're keeping an eye on the market, and I think I'm helpful at helping investors do that, they'll be able to profit from it instead of getting their heads kicked in. But they are normal, they are healthy, and they will happen. It's nature. I mean, if you drink too much, okay, you get a hangover. If you drink way too much, you get sick. If you get way too much, you go to the hospital. I mean, and so that's again, we are now at a point where people are going to be hungover. I mean, when the next thing comes down, and that's what you get for it. When trees grow to the sky, then they block out everything underneath. A bolt of lightning comes down. And it burns everything else. Nothing grows to the sky forever. It's cycles. Everything happens in cycles. It happens with sports teams. It happens in nature. We have cycles that, every day, 7 days a week, 12 months a year, et cetera, et cetera. Everything works in cycles. Don't ever forget that. Too many people, it's human nature to take a trend that's taking place right now in anything and think it's going to last forever, or at least last a lot longer. And it never does. Everything always changes. I mean, who would have thought, who would have thought that Donald Trump was going to be president in 2012? There's just a million things that change. And it's, and of course, there's the UFOs and UFOs, which of course, they're not the flying saucers, the unforeseen occurrences. We got one big time this year. There'll be others next year. And I guess for me, the thing I'm worried about most is also on the geopolitical front. I just think the thing with China is not the trade. I'm not worried about trade. Biden's going to keep those. He just announced this week he's going to keep the tariffs on for a while now. That's okay. But they're going to play with China. China is a growing power. This issue with Taiwan, I've mentioned this in the past. Watch out. If they show any inclination that they're going to move on Taiwan the way they did on Hong Kong, the world is not going to sit by like they did when Hong Kong has basically been taken over. Taiwan.
Yeah, real quick, let me just hop in. So I'm getting a wave of questions in the private chat here. But basically, people are asking. I wasn't clear enough. They're asking how do you get access to these 6 picks per month? So there's 2 checkout pages, guys. So the first link that I drop in, it's the one that's $67 a year. Go ahead and click through that one. And then you'll be asked to upgrade for an additional $200, and then you'll be getting 6 trades per month. It's only $270 a year, only $22 a month. And again, unlike markets, this is my favorite jokey tagline to use, but unlike markets, this is risk-free. Because if it turns out you don't like Matt, you like him today, you don't like him a week from now, just shoot us an email and we'll go ahead and refund you. The 6 picks a month is what I use personally. Just because I'm a little bit more active than doing 2 stocks a month. I like to do 6 per month. And if anybody watches my daily show, yes, I do steal ideas from Matt sometimes when I'll go out and suggest an idea. Just I like the way that he thinks about things. So again,
and we've had some great calls. Like I said, just over every, Invesco up 50%, Glencore 40%. Walgreens, I picked it. It went up 20%, then it went down 15%. Now it's back up 15%. Akamai is up. Well, it's up only slightly, but I only picked it a week ago. But it's already up 3%. We can go on and on. Intuit is up strongly. Micro, as I mentioned, Boeing, Micron Technologies. Let's see here. Chevron, which pays a big fat dividend, and that stock's up almost 20%. Patterson, it's Patterson, which is actually healthcare, in the healthcare area. Oddly, they do stuff for dentists and for dog food. But here's a stock that's up 22% in 2 months. Honeywell's another one that's up 25%. So we got some small names. And I will say this: there was one that I did pick. What was Alibaba, and the stock went down 8%. And I said, this is not working right now, and we got out of it. And that's what you have to do sometimes. We're not going to be right all the time.
And that's where I love what you're saying about stop losses. I'm a huge user of stop losses myself. I always have stops in because it takes the emotion out of trading and it makes it more of a thinking game.
Right, exactly. And the same thing happened with Pfizer. I picked Pfizer and then Merck the following week. I've stayed with Merck, great company in terms of great management. Pfizer, we made a nice little profit in it, but I just sat there and said, oh my God, wait a minute now. It's great that they have a vaccine, but how much money can they really make from that? Because if they gouge anybody politically, they'll get clobbered. Number one, and number two, right after they announced the vaccine, the CEO sold 60% of his personal holdings. Okay, there's a lot of reasons to sell. There's the old saying, but it's another good old saying. There's a lot of reasons people sell. One of them is not because they think it's going higher. Okay. 60% of the company of the position you hold in the company that you run, that's an awful lot. That told me that he's taking advantage of the situation. And then, of course, Merck this week just sold Moderna. They sold 100% of their position in Moderna. They had a very big position. Again, when smart people sell, I want to get out. And if I can go over a few more examples of that if you'd like to. Just another thing that I look at in terms of when you can use puts and make bets on the. I'll just go real briefly here. Is that Merck, again, they were just selling. They had a big position in Moderna, and they took a profit. But some companies sell themselves, of course. And one of the ways they do that is, of course, is an IPO. Most companies, they go through an IPO, they go public because they want to raise more money. They're a new company. But there are other companies that stay private for a long time. And if they suddenly decide to go public or sell to somebody else, that's a huge red flag. Goldman Sachs, one of the most important companies, probably the best historically over many decades, a Wall Street firm. They went public, sold themselves to the public in 1999. What happened 6 months later? The stock market crashed. Not BlackRock, but Blackstone, which is an unbelievably successful private equity firm. They went public in the summer of 2007, 6 months before the market topped out. They saw it coming. Okay, Sam Zell. Now this is a private company that he sold to another company. He didn't take it public. But he was one of the smartest, maybe the smartest, certainly one of the smartest commercial real estate people ever. And he sold, and he said, oh, well, I just thought, no. He sold because he saw the mania. He sold right at the top. Glencore, big commodities firm, they went public. It's over. Now, Glencore is one of the stocks I like now because it's gone through a 9-year bear market. So it's a great opportunity. But back in 2011, I said, look at this thing. Sell this stock. Do not buy this stock. Smart people. They're the biggest commodities trader in the world. They've been around for decades. And now they've suddenly decided to sell themselves after a huge rally in commodities. They know the gig is up. Now, this is not tulips like, oh my gosh, none of these companies are going to go out of business, but they saw their businesses were going to see multi-year highs and they got out. Now, having said that, like I said, some companies sell to the public because they're just trying to raise money, okay? And so don't just because a company goes public, you ought to, oh my gosh, that means that they're getting out. And for instance, also Microsoft, Bill Gates, all right, he went public. The stock kept going for decades and still going up, Bill Gates did not sell. He sold $1 million. That was it. He sold and kept buying after that. But he sold $1 million because he was still living in his mother's garage. So he needed a little money. So it was the venture capitalists that sold when they went public, not him. So when the insiders, the guys who really know the business, when they sell, get out, take your profits, look for something else. So be looking. Again, that doesn't happen every year, but it does happen more often than people realize. And when you see smart people like Merck decide they're going to get a Moderna, tells me that when the stock was at $190, it's probably not going to get back to $190 anytime soon.
Hey, see, no, I'm glad you said that about Moderna, because I'm in that one. I own that thing. And maybe I am in it for free now because I had a nice run and closed out half the position. So everything I'm sitting on is that gravy.
Yeah, and you can let it run, but
it's getting toppy.
Yeah, I just get a little nervous when and then they've had a lot of insider selling as well. So and again, it's all above the book. They're not insider. They're not insider trading in any legal fashion. I'm not trying to say anything disparaging about the company. I'm just saying about the people who run the company. I'm just saying that when smart people, guys who are on the inside, make legal sales. And again, if somebody sells here and there, that's oh gosh, my kids are going to college, or I'm and I'm a CEO and I want to buy a house in Florida, fine. But when they sell 60%, that's a lot. That's a lot.
Yep, absolutely. Cool. All right, guys. So again, but before we head out of here, our time is coming to an end. Hop on and join us. I'll put the link in the chat one more time. But there's no reason not to go ahead and sign up. Again, you got that 2-week, that 14-day money back guarantee. And hop on over. Take a look at the newsletter. Read Matt's thoughts consistently. Get educated. Learn how he thinks about markets. He's been doing it for a long time with an amazing track record. And of course, you do get the actual stock picks as well to help give you some guidance. So I hope to see you guys there. This was fun on a Saturday. Again, like I said, the whole point of Benzinga is to empower the individual investor. We had an awesome turnout today. I'm looking at the Zoom and the YouTube in total. We've had about 1,000 people here with us, which is amazing on a Saturday. Wow. So yeah, it's great to have you guys.
And I'll just say 3 very quick things. Number one, next Thursday, look for me on CNBC. I'll be on Trading Nation. I'm on pretty much every week. And I'm on Bloomberg Radio, Bloomberg TV, and Bloomberg Radio frequently, and some others as well in the CNBC Asia. Number 2, ride the wave. The liquidity is still going to be plentiful. It won't be quite straight up like it was in November, but be looking to be much more nimble as we get into 2021. It's going to be a great year for traders, and but it's going to be you're going to have. It's not going to be a year where you can just buy and hold.
Cool. Awesome, guys. All right. Peace out. We will see you. We'll be back at it with our live show on a Benzinga YouTube channel, 8 a.m. sharp on Monday. So until then, happy studying, and Monday morning, happy trading, guys.
Thanks, Luke. Have a great one.
You too.